In today's video, we break down the relationship between order blocks and fair value gaps and connect them to the broader liquidity framework in smart money trading. Instead of treating them as isolated entry tools, we approach them as structured execution models based on market structure and liquidity behavior. You will learn when price is more likely to respect an order block, when a fair value gap carries higher probability, and why inducement often forms before the true move. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. So let us begin. As you already know, order blocks and fair value gaps are two zones that smart money traders rely on when setting their entries in the market. Still, many traders struggle to understand which of these areas carries the stronger probability and is more likely to be respected by price. In this example, the market reacts to the higher time frame order block, but ignores the lower time frame one. This reveals an important insight. When price repeatedly fails to reach your entry, it often means the setup has been refined more than necessary. Now, let us break down what is happening in this example. The market was moving in a downtrend until price shifted direction, pushed higher, and after removing the inducement level, finally produced a change of character by breaking and closing above this major high. With that change of character signaling a potential bullish trend, our focus shifts to finding a place to enter long. So where should we look for a long entry on this chart? But before we move forward with order blocks or fair value gaps, we need to pause and understand one critical element. What exactly was that inducement level that price removed? Because without understanding inducement, you will constantly refine entries at the wrong place and miss the real point of interest. At its core, inducement is the process of creating liquidity before the real move takes place. It represents the final pool of liquidity engineered to fuel the intended move, and it can appear in several different forms. The most common are structural inducement, liquidity-based inducement, and time-based inducement. Let's begin with structural inducement. Among all these variations, structural inducement is arguably the most important, because it occurs directly within market structure and creates patterns that traders encounter almost every day. A structural inducement happens when price generates a false structural signal, such as a fake change of characters or a misleading break of structure, encouraging traders to enter too early or position themselves in the wrong direction. In this example, price is trending higher and continues producing bullish breaks of structure to the upside. However, when we focus on the most recent break of structure, everything initially looks completely legitimate. Price breaks above the swing high and closes beyond it. Naturally, this leads many traders to anticipate buying opportunities at the demand zone or order block responsible for that break. Then the result becomes obvious. You enter the buy position and price quickly stops you out. This is a classic example of how structural inducement traps the majority of market participants. The reason becomes much clearer when we take a deeper look at what actually happened. This so-called break of structure was never a genuine break of structure in the first place. The entire move was driven by resting buy-side liquidity located below, inside the discount zone of the primary bullish leg. If you draw your Fibonacci tool from the swing high down to the swing low, you will notice that price never even retraced to the 38.2% level, let alone the 50% level of the previous impulse. This observation is extremely important. For us at ComLucro, any retracement that fails to reach at least the 38.2% level should not be considered a valid retracement. And even when price reaches only the 38.2% level, these shallow pullbacks often lead to inducements and liquidity grabs rather than clean, high-probability entries. Because of this, traders should always approach shallow retracements with caution. In a bullish trend, the preferred scenario is to wait for price to retrace toward the 50% level or even deeper, where price enters the discount zone. This is where institutional buying activity is more likely to be present and where you reduce the risk of becoming liquidity for inducement-driven moves. Now let's move on to the second type of inducement. Liquidity-based inducement is by far the most common form of inducement you will encounter in the market. It occurs when price deliberately creates a new high, a new low, or even a small order block or breaker that appears exceptionally clean, with the sole purpose of attracting traders into the wrong position, collecting liquidity, and then delivering the real move. And this process takes place every day across all markets and all time frames. The primary objective behind this behavior is to create stop losses that smart money can later use as fuel. By encouraging retail traders to position themselves on the wrong side of the market, their stops become a source of liquidity that can be collected before the true move begins. This is why you often see a small high form before a bearish move, a small low form before a rally, a false breakout before a reversal, or equal highs and lows swept by only a few pips. These events are not random. They are examples of liquidity being deliberately engineered by smart money. Now let's move on to the third type of inducement, time-based inducement. Time-based inducement occurs when the market creates a trap move during periods of elevated trading activity, most commonly right before or immediately after a major session open. This form of inducement is particularly powerful because it appears consistently day after day and provides traders with some of the best opportunities to develop a structured trading plan while staying aligned with institutional order flow. At this point, you may be wondering why this type of inducement occurs so frequently. The answer lies in what happens during major session openings. Several important factors come together at the same time. Fresh liquidity enters the market. New order flow is injected into price almost instantly. Retail participation increases significantly, and smart money takes advantage of these conditions to manipulate price, create a misleading move, trap traders on the wrong side of the market, collect liquidity, and then deliver the true move that was planned from the beginning. Now that we understand how liquidity is engineered before the real move, let us return to our original example. So where should we look for a long entry on this chart? The first step is identifying the discount zone, which contains both the higher and lower time frame order blocks inside it. If your goal were simply to participate in the move using the higher time frame order block, you could have placed a buy limit at the top of that order block with the bottom of the zone acting as your stop loss. This would have placed you in the trade, and price likely would have moved upward after triggering your entry. However, this type of entry comes with a wide stop loss, which reduces the reward-to-risk ratio and increases the potential damage if the trade turns against you. If your goal is to work with a tighter stop loss and a stronger reward-to-risk ratio, then your entry zone needs to be refined. This is why many traders shift their focus to the extreme lower time frame order block at the bottom. At first glance, this seems like the ideal choice, because it offers a very small stop loss and naturally delivers a high reward-to-risk ratio. However, if the extreme lower time frame order block were tapped every time, the market would constantly retrace deeply, creating a zigzag pattern on every swing, which simply does not reflect how price behaves in real conditions. So what is the practical solution? In many cases, order blocks will not be respected. What tends to happen instead, especially on the lower time frames, is that the fair value gap becomes the zone that price reacts to most consistently. With that in mind, we can now combine the concepts and evaluate what price is most likely to respect when approaching order blocks or fair value gaps under different contexts. But selecting the right zone is only part of the equation. The real edge comes from understanding how liquidity is drawn, how it is cleared, and how execution should be structured around that sequence. But what exactly is a draw on liquidity? It is the process of identifying a significant liquidity level that price is clearly moving toward. In practical terms, the market frequently gravitates toward areas where resting liquidity exists, such as equal highs, equal lows, or clearly defined swing highs and swing lows, because that is where clusters of pending orders are waiting to be executed and filled. You want to locate a key high or low on the 1-hour chart that price is approaching with intent. As shown in this example, we have a clear swing high on the hourly chart, and price is steadily drawing upward toward that level. We can reasonably anticipate price reaching this high because liquidity is resting there and the market seeks efficiency. If you cannot identify a clear draw on liquidity on the 1-hour chart, you can refine your perspective by zooming into the 15-minute chart to gain additional structure and clarity. Now let us bring this back to our core discussion. If execution depends on liquidity and structure, then the next logical question becomes, which zone is price more likely to respect under different time frame conditions? On higher time frames such as the 1-hour or 4-hour chart, price generally shows a stronger reaction to order blocks rather than fair value gaps. But when we move down to the lower time frames, price is far more likely to respect the fair value gaps instead of extreme order blocks positioned at the outer edges of the move. So let us imagine that price forms a structure like this on the lower time frame. As mentioned earlier, on time frames such as the 15-minute or 5-minute chart, price is much more likely to react to the fair value gap that appears above or below the order blocks and reverse from that gap before reaching the extreme lower time frame order block. Using lower time frame fair value gaps as entry points can be highly effective. Entries based on fair value gaps tend to produce a higher activation rate compared to relying solely on extreme order blocks. In a bullish scenario, this usually means placing your limit order at the highest point of the fair value gap, while positioning your stop loss beneath the extreme order block. The trade-off is that this creates a wider stop loss, and that naturally reduces the reward to risk ratio of the setup. Placing a tighter stop loss just below the lowest point of the fair value gap is also possible. The challenge with this option is that it exposes the trade to greater risk. The extreme order block sitting below the fair value gap may still attract price, pushing the market downward and triggering the stop loss. So even though a tighter stop may look attractive, it is important to weigh the additional risk before applying this adjustment. As mentioned earlier, on higher time frames, our main focus is placing entries at order blocks. Traders can still choose to rely only on order blocks in the lower time frames as well, but doing so often results in missed opportunities because price does not always return to those extreme levels. Now, we have already covered the scenarios in which price respects order blocks, respects fair value gaps, or interacts with both. However, there is another situation you may encounter in the market, one where price respects neither the order blocks nor the fair value gaps. Let us explore this scenario and understand the main reason behind it. You have likely experienced moments when you spotted an excellent setup and a strong opportunity to enter the market after all the rules of your strategy were met. You marked your ideal entry zone, set your pending order on the fair value gap or order block, and waited with confidence for price to return. You felt ready for the perfect trade, yet price simply continued moving in the intended direction without ever triggering your limit order placed at the extreme of the gap or order block. In the end, the trade played out without you. The main reason price behaves this way is the level of inefficiency it creates while attempting to retrace toward the fair value gap or order block positioned at the extreme. When price forms a large inefficiency on its way to those zones, it leaves behind significant liquidity voids. As a result, the market often pauses to fill those voids before continuing. This behavior highlights an important principle. Markets do not simply move from zone to zone, they move through liquidity sequences. And when we understand that sequence, execution becomes far more precise. This same logic is structured and repeated every day in specific intraday models, such as the Silver Bullet. The Silver Bullet is an ICT trading strategy that combines three main concepts: market structure shift, liquidity sweep, and fair value gap. When these elements align within specific trading sessions, they create a structured opportunity based on liquidity and confirmation rather than random entries. To trade the Silver Bullet, wait for price to break above the day's high during the London or New York session, and then quickly return inside the range, taking out the buy-side liquidity. This movement above a key intraday level attracts breakout traders, but the fast return inside the range signals that liquidity has been collected. This liquidity sweep above the key structure of the day suggests that a potential reversal may be forming, especially when it occurs during high-volume session times. Next, we wait for a bearish market structure shift to confirm this potential reversal. A bearish market structure shift happens when price breaks and closes below the most recent swing low. This shift indicates that buyers are losing control and that selling pressure is beginning to dominate. In other words, demand is no longer in control, and price may start pushing to the downside with stronger momentum. Then mark the bearish fair value gaps that form during the displacement move as potential supply zones. These imbalances often act as retracement areas where institutions rebalance positions. Set a sell limit order at the beginning of the FVG zone and wait patiently for price to pull back into that area. If new fair value gaps form as price continues to move, you can map out future opportunities. But always follow a clear and disciplined risk management plan to protect your capital. Similarly, in the bullish scenario, the logic simply inverts. Wait for price to sweep liquidity below the day's low during the London or New York session. A valid liquidity sweep pattern forms when price breaks below a key level and then immediately returns back inside the range, signaling that sell-side liquidity has been taken. Next, wait for a bullish market structure shift to confirm that the reversal is valid. Finally, mark the fair value gap created during the displacement and plan your entry accordingly. If the fair value gap is relatively small, remember to use a slightly wider stop loss to give the trade enough breathing room and protect it from normal market fluctuations. Now, let us bring this back to our broader discussion. Whether we are analyzing intraday models like the Silver Bullet or higher time frame order blocks, the underlying principle remains the same. Liquidity is cleared first. Structure shifts. Execution follows. If we examine this example on the euro-dollar pair, we can see that the market is in a downtrend and has already confirmed a bearish break of structure by breaking and closing below the most recent major low. There's an order block resting at the extreme, and just beneath it, we can identify a fair value gap. Both areas could be used as potential entry points. As price retraces downward toward these zones, we notice that it reverses before reaching either one. The reason for this shift lies in the inefficiency created during the retracement wave, which prevents price from traveling deeper into our marked levels. Let us look at a more general trading example that brings together the concepts we have discussed throughout this episode. On the screen, we have the euro-dollar 15-minute chart. We can see that price moved lower and mitigated the 1-hour demand zone located beneath the liquidity pool created by the equal lows. When we zoom into that area, it becomes clear that the higher time frame demand zone was respected. After this mitigation, price pushed upward and, once it cleared the inducement level, broke and closed above the most recent major high, forming a valid change of character. From here, our next step is to search for potential long entries. The first opportunity would have been at the order block positioned at the extreme. If that entry was missed, then the question becomes where to enter next. Price has made another bullish run to the upside and has now produced a bullish break of structure, confirming that the direction has shifted to bullish. At this stage, we have two possible entry methods to evaluate. The common approach many traders take is to rely on the extreme order block. In this scenario, there is an imbalance that must be filled, and the order block sits directly beneath the fair value gap. The strategy would be to wait for price to retrace into the order block, trigger the buy limit placed at the top of that zone, and then climb higher from there. In the second option, we're considering entering the market from the fair value gap area. This approach is commonly seen in lower time frames. When entering from the fair value gap, it's important to consider a key point. You could place your entry at the highest point of the fair value gap and set your stop loss just below the fair value gap area. While this strategy can be effective at times, it's important to note that your stop loss will be very tight. Additionally, since we have an unmitigated order block at the extreme, there is a possibility that the price could push downward to fill it. So I recommend keeping your stop loss a bit wider by placing it beneath the order block. The whole point of this type of entry is to reduce the possibility of missing a trade, although it does reduce the reward to risk ratio. Now let's consider what would have happened with both of the trades. For the first option, if we had waited for that order block, This is what would have happened. Let's say that we already had our take profit set at this high. It's clear that we would not have entered this trade since the price couldn't activate our buy limit order. If we had entered from the fair value gap, our buy limit order would have been activated and our take profit would have been hit by the price. We can see that the trade played out without pulling back to the extreme order block. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Lucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.